The first number you see controls every financial decision you make after it. Not some of your decisions, all of them. In 1974, psychologists Amos Tversky and Daniel Kahneman ran a deceptively simple experiment. They had participants spin a wheel, rigged to land on either 10 or 65, and then asked, what percentage of African countries are in the United Nations? The wheel was random. It had zero bearing on the answer, but participants who spun 65 guessed significantly higher than those who spun 10. An irrelevant number had silently colonized their judgment. They called it the anchoring effect. And 50 years later, it is one of the most reliably exploited cognitive biases in commerce, negotiation, investing, and real estate. Today, we're going to trace exactly how it works, why your brain treats first numbers as facts, and give you a concrete framework for spotting it and fighting back before it costs you another dollar. Anchoring isn't just a quirk. It's a feature of how human cognition processes uncertainty. Here's the core problem. When you don't know the right value of something, your brain needs a starting point, and whatever number enters your field of attention first becomes that starting point, regardless of whether it's relevant, accurate, or even sensible. Researchers call this insufficiently adjusted anchoring. You start from the anchor and adjust from there, but the adjustment is almost always too small. You never fully escape the gravity of that first number. What makes this particularly insidious is that it works even when people know about it. A 2006 study by Dan Ariely, author of Predictably Irrational, had MBA students write down the last 2 digits of their social security number. Then he auctioned off items: a bottle of wine, a cordless keyboard, a box of Belgian chocolates. Students with high social security endings, like 8099, bid an average of 216% to 346% more than students with low endings, 00 to 19. MBA students, rational actors, people trained to evaluate price objectively. The anchor still worked. And this isn't just laboratory trivia. The anchoring effect doesn't live in a lab. It lives in every store, website, and dealership you've ever walked into. Car dealerships. The classic example, and for good reason. When a salesperson walks you through the sticker price before discussing any discount, they're not being transparent. They're setting an anchor. The number 48,500 on SARS the windshield isn't the real price. It's the reference point your brain will use to evaluate every subsequent offer. When they come down to 43,000, your brain doesn't feel like you're paying 43,000. It feels like you saved 5,500. But compared to what? A number someone invented specifically to make you feel that way. The research on this is stark. Consumers who negotiate from a seller-set anchor consistently overpay, compared to consumers who introduce their own anchor first. Retail pricing was $109.99, now $79.99. That crossed-out original price is an anchor. It doesn't matter whether the item was ever sold at $109.99. Once you see it, your brain stores $199.99 as the baseline value. $80 now feels like a bargain, not a price to evaluate on its own merits. Williams Sonoma famously added a $429 bread maker to their catalog next to a $279 model. Not because they expected to sell many $429 units, but because having it there made the $279 version feel reasonable. Sales of the $279 bread maker nearly doubled. Restaurant menus. That outrageously expensive item at the top of the menu? It's called a price anchor. The restaurant isn't optimizing for selling their $185 Wagyu steak. They're optimizing for making the $65 salmon feel moderate. This is menu engineering, and it's been formalized in the hospitality industry for decades. You are being nudged before you've read a single description. Real estate listing price is an anchor. Studies consistently show that homes listed higher, even beyond market value, sell for more than equivalent homes listed lower, because both buyers and their agents make adjustments from the anchor rather than from comparable sales data alone. Genevieve and Meyer's 2001 research on Boston housing found that sellers who paid more for their homes set higher listing prices and achieved higher final sale prices. not because their homes were worth more, but because their purchase price acted as an internal anchor that colored all subsequent valuations. These are the two arenas where anchoring has the highest personal financial stakes, and where it's least discussed. Investing. The purchase price anchor. When you buy a stock at $80, that $80 becomes an anchor. When it drops to $55, you don't evaluate the current fundamentals. You evaluate the $25 gap from your anchor. This triggers a specific pattern. Investors hold losing positions far longer than they should, waiting to get back to even, a benchmark that has zero relationship to the stock's current or future value. This is anchoring fused with loss aversion. The result is portfolio damage that compounds over time, not just from the held loser, but from the opportunity cost of capital that could have been redeployed. A 2011 analysis of retail investor trades found that investors were 1.7 times more likely to sell a winning stock than a losing one, the exact opposite of what rational portfolio management suggests. The anchor kept them in the red. Salary negotiation. The first number wins. This is one of the highest value arenas to understand anchoring, and it's completely underutilized. Research by Adam Galinsky and Thomas Musweiler shows that the first salary number mentioned in a negotiation has a disproportionate influence on the final outcome. Whether you name a number first or let an employer name one, the trajectory of the entire negotiation follows from that anchor. People who name a specific high initial number outperform those who name a range, who outperform those who wait for the employer to go first. The mechanism: a high anchor shifts the perceived reasonable range upward. When you ask for $125,000, the employer's counteroffer of $105,000 still represents a significant gain over the $85,000 they might have offered if they'd set the anchor first. A 2003 study found that the final salary agreed upon correlated more strongly with the first salary mentioned than with any other factor in the conversation. Here's the nuance most finance channels skip. Anchoring is a cognitive bias, but cognitive biases are features of how our brains process the world. You can't opt out of anchoring, but you can control which direction it pulls you. Used intentionally, anchoring is one of the most powerful tools available to you in any negotiation. Naming a high anchor in salary talks, setting a low anchor when negotiating a purchase price, introducing a competing quote before a contractor gives you their number. These are all strategic uses of the same psychological mechanism that's usually used against you. The insight isn't anchoring is bad. The insight is every negotiation already has an anchor. The question is, who sets it? Knowing about anchoring is not enough to escape it. The Ariely MBA study proves that. But there are specific tactics that reduce its effect. Tactic 1. Pre-commit to your own reference point. Before you enter any purchase, negotiation, or market situation where a price will be shown to you, establish your own anchor internally. Research comparable values, write down what you believe the fair price to be, and commit to it before seeing the seller's number. This is the single most evidence-backed intervention against anchoring. The act of generating your own number reduces the influence of the external anchor, not perfectly, but significantly. In Musweiler and Strack's 1999 research, participants who were instructed to consider reasons why the anchor was wrong were far less influenced by it than those who simply tried to estimate a value. Tactic 2. Ask, what would this cost elsewhere? When you see a price, don't evaluate it against whatever the seller showed you before it. Evaluate it against alternatives. This forces your brain to locate the reference point in external reality rather than the anchor the seller provided. The simple act of pulling out your phone and checking a competitor's price, mid-negotiation, is one of the most financially protective habits you can build. Tactic 3. Delay reaction. Demand justification. Never respond to a first number immediately. Not with a counteroffer, not with an expression, not with, "That's high." Your silence removes the anchor's emotional power. Then ask the seller to justify the number. How did you arrive at that price? This forces them out of anchor psychology and into rational justification territory, where you can actually evaluate the claim. Tactic 4. Introduce your own anchor. First, in any negotiation where you have information and flexibility, name a number first. A high anchor in salary talks. A low anchor when buying. The research is consistent. The party who introduces the first credible number holds more power over the final outcome. Tactic 5. Treat stock purchase price as irrelevant. This is the hardest one because it requires you to retrain a deeply embedded intuition. Your purchase price is a sunk cost. It tells you nothing about what a stock is worth today. Build a habit of asking, if I didn't already own this, would I buy it at today's price? If yes, hold or add. If no, the anchor is keeping you somewhere you shouldn't be. The anchoring effect is not a sales trick. It's a feature of how human brains handle uncertainty, a cognitive shortcut that usually works fine and occasionally costs us thousands of dollars. The car salesperson who shows you the sticker price, the employer who names a range before you do, the retailer with the crossed-out original price, the investment app that shows your purchase price in red or green, they're all working with the same mechanism. What you can do right now, before your next significant purchase, write down what you believe the fair price is before you see a seller's number. That single act of pre-anchoring is worth more than any coupon or negotiation technique. Your brain isn't broken. It's just doing its job. Your job is to give it better information before someone else does it for you. That's the psychology of anchoring. And that's how you take your power back. If this helped you, subscribe for more breakdowns at the intersection of behavioral psychology and personal finance. And check out our short on the $1 pricing trap. Because anchoring and commitment bias are closer cousins than you'd think. See you Thursday.